Thanks for clicking. More than half of condo investors in the GTA are losing money. This according to a new report from CIBC and Urbanation. According to the report, those investors that purchased pre-construction condos 5 years ago, back when interest rates were much lower, are now facing much higher interest rates now that those projects have come to completion. Those condos are now cash flow negative, meaning that investors aren't receiving enough in rent to cover their monthly obligations.
Are they okay?
Fair enough. This report is definitely not going to garner a whole lot of sympathy from renters or from the public in general, which have seen GTA rents rise by over 15% in the last year. And, says the report, the situation is not likely to get any better over the next couple of years, as more and more condos come to completion amid higher interest rates. And, says the report, this could affect the amount of inventory coming to the market. So what I want to do today is go over the report, taking a look at what is going on in Toronto's condo market, take a look at some implications for inventory and prices, and then discuss what to look for next. Speaking of next, as we'll see today, what's going on in Toronto's real estate market is due in large part to the higher cost of borrowing. The Bank of Canada is set to make its next rate announcement next week on June 7th, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. The report begins by noting that in Toronto, condo construction does a lot of the heavy lifting, representing nearly 60% of all new construction in the city. Further, a large portion of the condos being built are being built for investors, with rental investors representing 59% of all condo units purchased over the past 5 years. However, condo investing has gotten much more expensive, with the price of new construction condos going up over 58% over those past 5 years. Those investors that bought, say, 5 years ago, are seeing their condos come to completion at a much higher interest rate environment. Rates are much higher than they were when those condos were initially ordered. And this is leading to much higher financial obligations on the part of investors than they would have anticipated 5 years ago.
You're f***ing me? No.
We've talked before on this channel about buyers not being able to close on their homes due to their homes not being worth what they paid for them, but this report is different. This report is about investors who purchased properties 5 years ago, were able to close, and are now seeing their costs skyrocket. The report found that 75% of condos that were completed in 2022 now have mortgages, and of those condos that have mortgages, only 48% are cash flow positive. So, for those rental investors that had their condos completed in 2022, less than half of them are making any money on those condos. They're not receiving enough in rent to cover their principal, interest, taxes, and condo fees.
Down 3 jobs.
And it makes sense. Back in 2017, when a large portion of these condos would have been ordered, a decent variable interest rate was sitting at 2.72%. Fast forward to now, and prime is sitting at 6.7%, and a decent rate is sitting around 6.5%. So that's a 4% increase in the cost of borrowing from the time that the condo was ordered to the time that the condo is completed. A 4% increase in the cost of borrowing that very well probably was not anticipated by that rental investor. And this is a big change from previous years. If we look at Urbanation's chart, we can see that in 2020 and 2021, with relatively high rents and low cost of borrowing, investors earned more than they spent on their condos. Once interest rates started rising much faster than rent prices, that situation flipped, and those condos are now costing investors an extra $200 per month out of pocket. And the situation doesn't look like it's getting better anytime soon. The report also found that negative cash flow position of these rental investors had risen to about $400 in the first quarter of 2023. So in 2022, these rental condos were costing investors about $200 per month out of pocket, and that had risen to $400 per month out of pocket in the first quarter of 2023. And the report says that this situation is likely to persist for some time, as more and more of these condos were sold for higher and higher prices, though at lower interest rates. They are now coming to completion and interest rates are much, much higher. And this, says the report, could be a big problem, as it does change the landscape for the GTA real estate investor, who may no longer be willing or able to buy condo pre-sales in the coming years ahead.
If you're not careful, you're gonna lose me.
And, says the report, if this happens, if the GTA real estate investor exits the market, if condo demand shrinks, then the builders won't build, which will hurt rental supply, pushing rents up even further. Not right now, not immediately, but in a few years from now. On the flip side, however, we could see a lot of these real estate investors sell their properties. And CIBC's Benjamin Tal says they would likely be welcomed into a tight real estate market, meaning they probably wouldn't lose money on those sales. And this report does lend some credence to the LePage report that we talked about in a previous video. That report showed that 31% of real estate investors were considering selling their properties over the next 2 years, with 36% in the GTA considering selling as well. However, the report does note that a lot of this does depend on the financial wherewithal of real estate investors. If investors are able to access additional financing, if they're able to deal with their negative cash flow position for the time being, they may be willing to hold on to their properties for longer, waiting for those prices to rise, waiting for rent prices to catch up.
Oh, I hope I can help you.
On the other hand, if credit tightens, if we see a recession, if the economy gets worse, we could see a lot of these properties be unloaded onto the market. Now, that doesn't mean that the GTA market will be overloaded with a new abundance of condo supply from scared investors, but it's still new supply coming to the market nonetheless. With all of that said, all of this will be largely dependent on how long the Bank of Canada can keep interest rates elevated, and we'll obviously continue to track the bank's policies on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.